Welcome to Financial Education for the Nation. My name's WarrenShute. I want to take a few moments to talk to you about small cap investing and how to improve your portfolio by exposure to these companies. So our portfolios, a collection of investments, are generally exposed to the broad stock market. So we buy the UK, the US, Europe, the Far East and emerging markets as a whole. We weight it, in other words, we hold more of those companies, those countries that are larger on market cap than the smaller ones. So for example, we hold a lot more of the US than we do the UK. That's purely because they have a bigger influence on the world economy, and research proves to us that this is the way to go. Some people have what we call a home bias. They'll hold more of the UK. There's no academic research to prove that this works, but if it's your fancy, then hey, that's fine. But more specifically, when we look at the stock market carries risk. And if we can accept lots of risk, if we have lots of time on our side, we can have lots of stock market exposure. But I liken this to a scotch. Some people like a strong scotch, they have it neat. Other people dilute it with water. And if you don't like the risk exposure of the stock market as a whole, you can dilute the exposure by including short and medium term fixed interest. Make sure you get that right. Short and medium term, not long term. That will reduce your risk. But let's go back to the stock market section. So we have the stock market exposure. Not all parts of the stock market perform the same. There are two specific categories or groups within the stock market that do particularly well. One of those is small cap, i.e. the small companies, and one of those is value, i.e. the cheap companies. The small cap companies, which we're going to talk about today, generally over time outperform the overall market. Now if you think about it, it makes logical sense. When we buy into the stock market, we're getting a compensation, a reward for the risks we're taking. So we give our money to the stock market performs, we receive a better return because the money goes up and down over time. If we look at small cap or small companies, they're riskier. They're higher risk than the overall market. So therefore we should receive a higher return over time. That's not every single year, but over time we generally receive a higher return on the small cap companies. That's why at Lexo, my online investment firm, and Lexington Wealth, we tilt our portfolios about 20% to small cap. And we still diversify that small cap globally throughout the world. I hope this has been helpful. That explains to you why small cap give you a premium over the overall market. If you have any questions, please connect with me. My name is WarrenShute, and this has been Financial Education for the Nation. Thanks for watching. Please connect with me on social media: Facebook, Instagram, LinkedIn, and Twitter. I'd love to hear your feedback.